Michelle Makori coming to you from New York, and this is Kitco News. Joining me now is the man that the Wall Street Journal named the godfather of smart beta. Rob Arnott led the team that invented the fundamental index back in 2003, and he currently serves as chairman of Research Affiliates, which advises on over $175 billion in investment assets. Rob, very good to have you with us.
It's a pleasure.
All right, Rob, we have a lot of ground to cover, including if there is still value in value investing. But I want to start off with your macro outlook and Treasury Secretary Yellen warning that enacting President Biden's economic agenda is critical to maintaining America's status as the world's top economic superpower.
We've grown used to America as the world's preeminent economic power. But we aren't destined to stay that way. With these investments, though, I believe we will. We have a chance now to repair the broken foundations of our economy and, on top of it, to build something fairer and stronger than what came before.
She's pushing for investment across the board, from climate change to what she calls human capital, and she's trying to rally the public behind the bipartisan infrastructure bill and the Democrats' even bigger $3.5 trillion spending plan. So, Rob, what is your take on that? I mean, what do you see the impact of these spending plans should they happen? And they will most likely happen in one form or another. What impact are they going to have on the economy?
Well, firstly, it remains to be seen how much of it can pass in a closely divided Congress. The notion that America's greatness and stature in the world and the world economy hinges on government spending is patently absurd. The nation has been a great nation because of self-reliance, because of entrepreneurialism, because of being the world leader in invention and innovation. And almost none of that comes from the government sector. So when you have stimulus, what does it stimulate? It certainly doesn't stimulate greater economic activity because basically you're taking money out of the economy and then putting it back into the economy in the areas that government chooses to fund. Well, the likelihood of the government selecting investments better than entrepreneurs is slim to none. So therein lies one of the problems. So what does it stimulate? It stimulates corporate profits. We have a paper that shows that every $1 trillion of deficit spending props up corporate profits over the next 4 quarters by about $250 billion a year. So it all makes its way into corporate profits. Well, I mean, higher profits as a capitalist, I should love that. Yeah, if it's earned. If it's a transfer, that's crony capitalism. It's not helpful for the broad macroeconomy. Monetary stimulus makes its way into the economy by way of the capital markets. Fiscal stimulus makes its way into the economy and then through the companies that are funded by the fiscal stimulus back into the corporate arena. So it's all just a lot of shuffling paper. It empirically doesn't improve economic growth at all past the first 6 months or so.
All right. Well, it doesn't improve, but does it hurt? Does it harm the economy? What are some of the consequences on the downside to this? Is inflation, which we're starting to see, one of them.
Now, the Fed has to say inflation is transitory. Why do they have to say that? Because if consumers start to fear inflation, start to think inflation is real and is sustained, they'll change their behaviors. And if they change their behaviors, it locks in inflation. Wage demands become more rigid and biased on the upside. Costs of goods and services and the ability to pass through higher costs of production becomes greater because people are expecting those price hikes. So one of the fascinating things is over a fourth of CPI is based on housing costs, and well over half of housing costs are not rents, but homeowners. Okay, why does that matter? Homeowner inflation is determined by something called owner's equivalent rent, meaning how much would your house rent if you put it out for rent today? Well, how do you measure that? You go around to tens of thousands of people and say, what do you think your house would rent for? And then you ask them again a year later. It's a lagging indicator because people will be anchoring on their last year's number when they answer that question. And we've seen housing prices soar 17% in the last 12 months. Owner's equivalent rent is up 2.6%. Okay, that's a big gap. And so that's going to be playing catch up for the next 2, 3, 4 years because it's a lagging indicator on inflation.
And yet the Fed is signaling that it's not ready to really even start discussing in any earnest way taking any kind of action. The Fed has put a lot of emphasis on the unemployment data. We got some disappointing data from ADP on that front, showing that there were the fewest job gains in 5 months last month. Private payrolls rising by 330,000, less than half of the 695,000 jobs that had been forecasted. We've also got GDP disappointing, rising at 6.5% in the second quarter. That's the first read at least, well below estimates of around 8.4%. So what does that signal to you? What do those economic indicators tell you, Rob?
Well, we've had a robust recovery ever since last summer. And if you've got a robust recovery, you don't need monetary stimulus. You don't need the Fed creating free money. Free money has other consequences. Firstly, doesn't go to everyone. It goes mostly to the government, but also to the highest rated corporations. But interest rates, charging money to borrow, acts as a speed bump on reckless spending. Now, that's true for governments, but it's also true for companies. Companies will engage in empire building. If they can get their hands on free money, hey, why not? Now we've got the free money. What do we fund? Certainly not our highest priority projects. It's the next. And pretty soon you're down to projects that really don't have much merit. So you wind up propping up zombie companies, encouraging malinvestment in areas that aren't likely to be growth engines into the future, and encouraging government to get bigger and bigger, with the result that you draw the resources out of the private sector into a far less productive public sector.
So by that reasoning, do you think that U.S. equities, by and large, are overvalued at this point?
Oh, they're very overvalued. The saving grace is twofold. One, what's been called TINA, there is no alternative. If interest rates are zero, are you going to put your money in bonds? Probably not. The other element is demographics. The baby boomers, I'm a baby boomer, we're halfway through the process of getting the baby boom retired. And so you have tens of millions of baby boomers underprepared, underfunded for retirement, and worried about Social Security and Medicare breaking down. So they wind up putting everything that they can get their hands on into the markets to invest. Valuation indifferent buyers, they don't care what the stocks cost. They want to put money into the markets so that they have a little bit more of a cushion to retire on. And so when you have large cohorts of valuation indifferent buyers, that props up markets. Roll the clock forward 15 years, the whole baby boom will be pretty much retired, and they will be valuation indifferent sellers. They have to sell in order to buy goods and services in retirement. So I would think that the outlook for stocks on a near-term basis, no strong opinion either way. On a long-term basis, I'd be very pessimistic about US stocks on a 15-year basis.
How pessimistic?
We have a website. If your viewers Google Asset Allocation Interactive. It'll take you straight to our website, in which we forecast long-term returns for 130 different asset classes. US stocks are dead last among the stock markets in the world, with an expected return of 1.8% per year for the next 10 years. Most people don't buy, that's less than inflation. And it suggests prices not moving, you collect the dividends, prices don't move, and you lose ground in real terms against inflation. That's daunting. So do you put your money in bonds? No, those are expected to give you slightly less than that in terms of 10-year returns. But it's not that there's a lack of interesting markets. There's a host of interesting markets. It's just not ones that are engaged in reckless spending.
So you're saying that your forecast for the next decade is that investing in the US equity market is actually the worst choice you could possibly make. You're going to get 1.8% return, if I'm hearing you correctly. Give me your top two, top three. Where shouldn't I be putting my money for the 10-year horizon?
You know, the emerging markets are awfully interesting these days. If you want to put money in bonds for nice income, emerging markets bonds currently have yields that are just about identical to US junk bonds. Okay, but there's a big difference. Junk bonds have high risk of default. Emerging markets debt, not zero risk, but much lower risk. Historically, the default rate for emerging markets debt has been, a third to a fourth that of US junk bonds. If it's a third as much default risk, then why on earth does it have as big a yield spread as US junk bonds? Emerging market stocks are priced 60% cheaper than the US. Now roll the clock back to 2008, it was priced 40% above the US. And here I'm talking about price relative to long-term average earnings. Emerging markets are priced about 16 times the 10-year average earnings. The US is at 38 times. What's the highest it ever got? 44 times during the tech bubble. So that's worrisome. But emerging market stocks aren't the only possibility. Emerging markets value stocks, ignoring the Alibabas and the Tencents of the world, which are extravagantly expensive. The value side of the market in emerging markets is really cheap, trading at less than 10 times the average 10-year earnings. That means every $100 you invest, the companies are earning $10, and that's on average over 10 years, so that's sustainable. Where in the US, they're earning $2.60. Ouch.
Right.
So the opportunity in emerging markets deep value, I think, is extraordinary.
So if you could break down for us which emerging markets in particular, or if there are any indices that
I like to
you would
diversify.
recommend?
Sure. I like to diversify. I don't like to pick individual countries unless there's radically different valuations.
Is there an investment theme that you look at with emerging markets other than the value play?
Well, here's one thing that emerging markets have going for them, and it's a very ironic thing. COVID has been a catastrophe for the world, and particularly for emerging markets. They're under-vaccinated, so people are terrified. The best time to buy anything is when people are terrified. And so they're being
be
held.
greedy when others are fearful.
Right.
And be fearful when others are greedy, that old adage.
Right. So the only thing people want to buy in emerging markets are those tech darlings, and they're very expensive. So, hey, take advantage of the out of favor and unloved. The other thing is Yellen's urging of massive ramp ups in stimulus when we've already got a fast growing economy, when we already have more job openings than in many, many years. They can't do that in the emerging markets. They don't have the ability to engage in massive stimulus, massive borrowing of money they don't have to spend, massive printing of money. So they're constrained to not make our mistakes, which means that the bargains are very real.
But are there factors that you look at when determining which emerging markets to invest in? For example, government oversight, regulatory issues?
Well, I'm not allowed to talk about individual funds except because I'm not a broker dealer, except I am able to say what I'm invested in. And one of my favorites is Freedom Fund, FRDM, which invests in the 10 most free emerging markets economies with the least government control, with the most respect for human liberty. And then the 10 largest stocks in each country, equally weighting the 100 stocks. Now, equal weighting means you can't load up on the most popular, beloved, expensive stocks. They're there in the portfolio, but they're 5% of the portfolio. The bulk of the money goes to stocks that are really pretty reasonably priced. Others that I have big allocations to would include PIMCO's RAE Emerging Markets Fund, PEIFX, and for tax-exempt assets like an IRA, its sister fund, PEFIX, which is not as tax-advantaged, but has an added kicker of incremental return from PIMCO's bond scale. And my biggest allocations are to PIMCO All Asset, which is a global asset allocation strategy that diversifies away from mainstream US stocks and bonds. It struggled in the 2010s because it diversifies away from US stocks and bonds. And so it excludes the assets that were the best performing in 2010, and yet it produced a very respectable return. Just not as good as US 60/40. We're in a business where people love to buy what's gone up the most.
Yeah.
Better is to buy something that has performed in accordance with its expectations and is now cheap. So these are all funds and strategies that I have personal big allocations to.
So fundamentals of value investing there, but very focused away from the US and onto emerging markets that have the best functioning and least corrupt governments. I do want to circle back to the US and to the idea of the pandemic and what opportunities, if any, do you see that may have provided as we potentially are getting back to normal? Hard to tell with this Delta variant and potentially new mandates, but for the most part, there does seem to be a recovery theme. So do you see any opportunities that the pandemic has presented in terms of how it's transformed the way we work and live?
Yeah. Well, I have a paper coming out shortly that looks at unintended consequences, collateral damage from the COVID pandemic. And a lot of it has to do with our policy choices, not with the virus. So one of our findings is that suicides, homicides, accidents, and overdoses, what are called unnatural deaths, up about 70,000 above the normal run rate since the start of the pandemic. How much attention has this gotten in the media? That's 70,000 people dying. We've had 600,000 die from COVID or die with COVID, maybe not from it. But 600,000, most of them were in their last year or two of life. Now, the 70,000 unnatural deaths, those are spread across the age spectrum. So most of them had half a lifetime ahead. This means more years of life lost to the shutdowns than years of life lost to the virus. Really quite appalling and shocking that it's gotten very little attention. In any event, one of the main things about COVID is this too shall pass. Roll the clock forward 5 or 10 years. Is this going to be anything more serious than just a bad memory? It'll have left a trail of death and economic destruction, but the economy has already shown enormous resilience and ability to rebound. and even the ability to fund unprecedented stimulus spending, most of which we all know goes to waste.
Well, the pandemic has, of course, also created some opportunities and changes. Vaccine maker Moderna, for example, joined the S&P 500 recently. Rallied on that news, of course. News of index changes often results in investors piling into the stock that's being added. The presumption being that higher prices are coming as a result of index tracking funds now forced to buy the stock. Moderna stock up over 285% or so year to date, really had a great rally there. But you have said that an investor is better off steering clear of the stocks being added and buying the index deletions rather. And you were accurate on that call with Tesla. You predicted that Tesla would underperform the company that it was replacing in the index, Apartment Investment and Management. So does that apply to Moderna? And break down this thesis for us.
By about 80 percentage points. Buy the future, not the present. The market today's market prices are driven by narratives. The vaccine producers, phenomenal job creating vaccines in record time. The Moderna vaccine, for instance, China published the genome for the COVID virus. I believe it was on January 11 last year. 48 hours later, Moderna had the design for the vaccine. Now, why did it take 11 months? Well, thank you, CDC and FDA, for dragging it out 11 months before it could actually be rolled out. But never mind that, it was rolled out. And the result is we see these breathless reports of soaring cases as a consequence of the Delta variant. We don't see breathless reports of soaring deaths because the deaths aren't soaring. And they're not soaring because of the vaccine.
But break down your theory, if you will, as to why you should buy the index deletions as opposed to the ones that are being added.
This is the narrative issue. Moderna is soaring on the basis of a narrative that there will be enormous demand for their vaccines. And there will be. But it's already in the price now. The price is up 280%. Do you want to buy it now or do you want to buy it a year ago? Well, actually, when they were first rolling it out, the notion buy on the story, sell on the news is a time-honored cliche in Wall Street. But the notion of buying Moderna right when their production of the vaccine is at peak levels and a year from when that vaccine will no longer be particularly needed, that's probably not the right time to buy. I prefer to buy things that are unloved and out of favor.
Two points on that one. One, people are saying, well, we don't know what's happening with these vaccines. You maybe require booster shots. We're seeing now that a lot of places are demanding that you show proof of vaccination before you're allowed access to indoor dining. That's certainly what's happening here in New York. And if the idea is pushed that you need a booster shot and you have to get a vaccine shot every year, if not a booster one every 6 months, who knows how that's going to play out? Doesn't that bode very well for Moderna then?
It does on a near-term basis. And the thing is, stocks that are trading at lofty prices, they trade at lofty prices because they're great companies with great products. But you're prepaying for the growth that's expected. In order for those stocks to beat the market into the future, they have to exceed the lofty expectations.
All right.
They have to do better than the consensus view of their future growth.
Okay, very quickly, before I let you go, I mean, obviously, you are very well known for your position on value investing. And many investors are re-examining their exposure to value investing, being somewhat disillusioned because that approach has really underperformed over the past 13 and a half years or so relative to growth investing, that is. So is there still value in value investing?
You know, it's interesting. I did a paper in the Financial Analyst Journal the first quarter of this year. It's already the third most downloaded paper in the history of the journal. And the title is Reports of Value's Death Have Been Greatly Exaggerated. The point of that paper is that value has underperformed sharply. If you use classic price to book value, which is a terrible measure, but it's the most popular measure for defining value investing. If you use price to book value to select stocks, choosing the bottom 30% of the market in terms of price to book value, it's underperformed for 13 and a half years since early 2007 through summer of 2020. 13 and a half years of underperformance. It underperformed the growth stocks by 58 percentage points, just a huge drawdown, but it got cheaper by 68%. So what do I mean by that? The spread between growth and value went from a 4-to-1 ratio back in 2007 to 13-to-1 ratio tail end of last summer. Growth stocks 13 times as expensive as value stocks. That's unprecedented. Never happened before. And the snapback since then has been nice, but it's gotten you only about 1/10 of the way back towards historic norms. So value is cheapest it's ever been relative to growth stocks, which represents an extraordinary opportunity. So the point of the paper is the only reason value underperformed is that it was falling out of favor and getting cheaper, not because the underlying fundamentals were getting worse. The underlying fundamentals for the value portfolio were doing just fine.
But does that matter if the stock price doesn't reflect those fundamentals?
It does matter in the sense that buying value today, you get a lot more for your money, more profits at the company level, more income for the shareholder, more book value, net worth of the company as a foundation for funding future projects. And because of that, you get 13 times as much of those underlying fundamentals as you do with growth stocks. And so that's a great foundation for future performance. If they don't improve in relative valuation, they would still outperform because you're getting more profits per dollar you're investing. If they do mean revert back towards historic norms, you could see value outperform growth by over 100 percentage points in the coming 5 years.
So value investing, but outside of the US, if you have a 10 to 15 year horizon, look at emerging markets.
To the extent you want to stay in the US, buy value stocks. Don't buy the frothy growth names. To the extent you're willing to depart outside the US, put as much money outside the US as you feel comfortable.
All right. Well, thank you for sharing those insights with us. We really appreciate it. Rob, Arnott, good to have you with us here on Kitco News.
It's been my pleasure. Thank you.
Thank you. Keep it here. We'll be back with more.